Equity Mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast that follows our journey of investing. Whether you're an absolute beginner or approaching Warren Buffett status, our aim is to help break down your barriers from beginning to dividend. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. I'm very excited for this interview. We've got a returning expert who I like to think is one of our correspondents in two ways. First of all, an American correspondent, well, an Australian who's making it over in the States.
Yep.
And then second of all, our correspondent from the world of value investing.
Yes, I know. And we're really excited. We're really excited about this interview. It's our absolute pleasure to welcome back to Equity Mates, Tobias Carlisle. Tobias, welcome.
Thanks, fellas. That was a really kind introduction. I love those intros. Yeah, I remember when I used to watch daytime TV. I'm not, like morning TV before I went to work in Australia. And sometimes I'd flash over to the dude in Los Angeles, and I think, there we go. That's the job that you want.
Well, you've got it. You've got the job
now. Yeah.
But I've put the green screen up so you guys can stick in whatever kind of Los Angeles background. You'll put the Hollywood sign up behind or something like that.
That's actually a good idea. So
for those from my mum's basement in Roma or something like that.
So for those who
I'll look it up on the internet when you ask me what the weather's like.
If you have just joined Equity Mates for the first time, welcome. Tobias has joined us many times before. We would stress and encourage you to go and listen to our previous episodes with him. Tobias is the portfolio manager of Acquire's funds, including the New York Stock Exchange listed ETF Acquirers Deep Value, ticker code DEEP, and the author of multiple books, including Deep Value and the Acquirers Multiple. Tobias is an Australian, now based in the United States, as Ren said, and is our absolute go-to on all things value investing. And given the recent sell-off in the high growth part of the market, the largely unprofitable companies, we thought that it would be a really interesting time to check in with Tobias to hear his take on the market and how he sees things playing out. So let's crack in.
Yeah, so Tobias, let's start big picture. If we've been living under a rock for the past 6 months, haven't turned on the news, haven't checked the markets, can you sort of summarize what's been happening, especially where you are in the States? What have we seen over the past 6 months?
Let's wind back a little bit more than 6 months. Let's say 12 months. So, as sometimes happens in the markets get speculative, and stuff that's sort of more pie in the sky, sort of the vibe of it, rather than actually making any money or doing anything like that, which ultimately is what you want your public companies to do. But the stuff that promised better returns sort of down the road ran up a really, really long way. And that happens sort of regularly in the markets, but like say every 10 or 20 years or so, you get a speculative bubble, and it's often concentrated in tech. Is very popular. Tech there was a tech bubble in 1969, there was a tech bubble in 1999, and there's probably been another one that we've just gone through. And so that all ran up. I don't know whether it was the COVID lockdowns or stimulus payments or easy money. It sort of all exploded 2019, 2020, and it topped out February 12 last year. And I think the best representative of that is the ARK, Cathie Wood's ETF, ARK, ARKK, which topped out at $156 on February 12 last year. And since then, the companies in that ARK complex have been down sort of variously 75, 80%. Some of them deservedly so. There's probably some in there that are getting to good value. I haven't sifted through. I haven't seen a lot of them because I tend to be. I'm a deep value investor. So if you think about Buffett as being, Buffett's like he calls himself a franchise investor. He's looking for stuff that will compound and grow over time. Likes brands, well-known brands and things like that. So Apple's a great example, or Coca-Cola. Those are famous things that he's held. See's candy, which is very sort of popular over here. Those things grow and compound over time. So he says he'll pay a reasonable price for what he regards as a wonderful company. What I try to do is I will buy at a bigger discount for a less good company. They can be cyclical businesses. And so I, end up with a portfolio that can be a little bit heavier, industry, cyclicals, and that stuff tends to be, that's when the market is ripping and all the really speculative stuff is going well. Nobody wants to be anywhere near the cyclicals, so the cyclicals got smashed to smithereens, and they've had a little recovery over the last sort of 12 months. Like basically, when Kathy's portfolio topped out on February 12, that's the worst relative performance I've had in my entire career, but certainly which showed up in the ETFs, and then I've gone the other direction since then. So I've had a pretty good run over the last 12 months. And I've got two ETFs. I've got the Acquirers Fund, which is ZIG, which is mid cap and large cap US equities, and Acquirers Deep Value, which is small and micro. And the ticker on that is DEEP.
Yeah, nice.
I love the ticker codes that you get with ETFs, DEEP and then ZIG, which I imagine is you zig when others zag.
That's the idea. Yeah.
So Tobias, can you talk us through what are some of the metrics telling us since Feb 12 last year when we saw the peak of ARK? How does this fall over since then to now? How does that compare to some of the other falls that we've seen in our lifetime? You mentioned there the 99 into 2000. Of course, there was the 2008 GFC as well. Is this time any different?
Well, I don't think so. That's an interesting question. So I didn't mention in that earlier. I was just the two examples that I gave earlier. They were like the 69 bubble. And that was when, like, if you just had Tronics in your name, it was like electronics was the big thing then. That's pretty funny, isn't it? And they were the really popular things of the day, and they all got smashed up. And then the famous bear market was like the 73, 74 bear market, which was actually worse than 1929 on a real basis because they printed so much money that nominally it wasn't as bad. So nominally it's like, what did the actual index do? But real is like adjusted for inflation. And so adjusted for inflation, 73, 74 was worse than 29, which is kind of hard to wrap your head around. But that's statistically, that's true. And so then the next one, there may have been another one in between. I just don't think of it this way. And then 1999, 2000 was a similar thing where it was the dot-com boom. The dot-coms and the electronics, they're kind of like the emblematic stocks of the bubble. They're the things that everyone thinks about. But it does tend to be a little bit more broader based than that. So the 69, 70, 73, 74 kind of boom and bust, that was the Nifty 50 era. And the idea was that there were these 50 stocks that was so good that you just had to have them in your portfolio and you could pay any price for them. And it didn't matter because they grew so fast that over time, whatever price you paid for them, they just grew into them. So you paid these enormous price to sales metrics, very stretched, and it would grow into it. And then that sort of thesis was found out subsequently when all of that stuff got smashed to smithereens, even though they did ultimately tend to perform quite well. But you just don't want to be paying over what something's worth when you're buying it. Same thing happened in 99. The stuff that everybody knows about is all the dot-com stuff that everybody was in. And the same thing will be this time around. It'll be the ARK. I don't know if it'll be software as a service or what they'll ultimately decide will be the emblem of the whole thing. But 99, 2000, like Walmart got really expensive. Walmart, even though underneath it was a very good business, it was still compounding away. Like the business was growing at like 30% a year still over that entire period. The stock just went nowhere for 15 years. Microsoft was the same. GE, same deal. Everything just got too expensive in 1999. And what tends to happen, they have a little bit of volatility, they crash with everything else, but then they can't ever kind of rally back. And so you get 10 or 15 years of just going sideways. And I suspect the same thing will happen this time. There are a lot of good businesses out there. FANG might be it, something like that.
So Tobias, hearing you talk about the Nifty 50 just makes me think about the index era that we're living in today, where we talk about the FANG stocks as sort of these brilliant companies that you can sort of buy at any price, but also just, the ASX 200 index over here in Australia, S&P 500 over in the States. Do you think there's echoes of this Nifty 50 thinking in today's sort of passive investing market?
100%. And it's, as you point out, I think the new word for the Nifty 50 is FANG. or fat man or whatever kind of fat man includes Tesla.
I think Bryce and I are trying to coin Ant Mama, and you include Tesla and Nvidia now.
Yeah, I like that. It's funny, a few of those names have taken a header. So Netflix has taken a header. Facebook's taken a header. If I had to pick one, Tesla, I just shake my head all the time at Tesla. I don't understand how Tesla trades. It's silly expensive and it's not that great a business, but it is growing pretty quickly. So it might be that the growth just fools people for a while, but it doesn't actually, not much of it falls down to the bottom line of that business. So I think that, FANG probably that will be the Nifty 50. And it's entirely conceivable to me that in 10 years' time, we could look at some combination of those bigger companies, and they haven't really gone anywhere. Although, having said that, I would take it on a case-by-case basis, because I think Facebook is undervalued here. The question is whether the business will be as good as it has been in the future. Microsoft, you can run a chart of Microsoft's multiple expansion. It's amazing. It has grown earnings very quickly, but the multiple expansion's been even higher. It's a ski jump kind of look to it. It's hard to see it doing that again, the ski jump part of it. The earnings could keep on going, but maybe the valuation will not go up as fast. And then Alphabet doing a little buyback, so evidently they think that's cheapish. Amazon too. I can see these things maybe muddling through, but I don't think the next decade will look nearly as cheery as the last decade has looked.
Yeah, interesting. So to us, a lot of the focus has been obviously on the collapse of the high growth and the vibe companies that you mentioned at the top.
I like that term. We're going to coin that term.
The vibe companies, yeah. A lot of the Equity Mates community are
I can't use that over here because only Aussies will get the vibe of it.
Yeah, they get the vibe of it, yeah. And a lot of our community have obviously bought into those companies and have had a great run. Are you seeing similar sort of falls in the value part of the market? Something that we don't necessarily discuss as much on the show, so it'd be good to get your thoughts on that.
Yeah, value sort of had its bear market. So I got a friend, Mikhail Samanov, who's stitched together these 3 data sets that run back to 1825, and it's the data gets progressively worse as you get further back. But there was this the gold standard of data in the States is the French data set, and that's Ken French, who's Fama and French, who did this famous research that came out in 1992 called the cross-section of returns, and that's where he came up with, he and Fama, Eugene Fama, who's got a Nobel Prize for behavioral economics. They were the ones who identified the different factors, and one of the factors is value, which they defined as price to book, which I don't use and nobody uses. No practitioner uses price to book, but it's academics like it because it doesn't vary much from quarter to quarter. Book's pretty steady. Your assets don't change much, whereas your earnings can be up and down and cash flows up and down all over the place. So he just advocated for, they advocated for these factors, saying that there's a market factor, that's beta. Anybody's done any sort of entry-level finance will know there's beta, and then there's additional risk and volatility, and then you've got the small minus large, which is the small factor, and high minus low, which is the value factor. And they've identified another 206. There's probably as many factors as there are stocks now, so it's not very useful anymore. None of them are really useful. But they have their data set that runs back to about 1926. And then there's another data set by the Cowles Commission, and he had this question. It came out in 25 to 1875 or something crazy like that. And he had this question whether there was any skill in stock picking, and he got these people who wrote newsletters and he put them on punch cards, which was the first time that anybody had used a computer to do any of this stuff. And Benjamin Graham saw it. It was where Benjamin Graham got the idea, legend has it, for his sort of value strategy, where it said you could do about 15% a year if you just bought these cheap stocks through this period of time. But the Cowles Commission, Alfred Cowles was his name, he decided that there was no skill in stock picking. It was a random walk, which is where we get a lot of the efficient market theory from. But then these guys more recently have gone and found every annual report from a public company that they could dig up from 1875, and I think it goes back to 1825 in the States. Because they didn't have to publish all of the financial statements that we get today, they might have given you a balance sheet, but they weren't as complete as they are, and there was no standardization. But they did, if they paid a dividend, you could use that as a proxy for value. So they've looked at the dividend yields of these companies and found that companies with higher dividend yields perform better. So what they have been able to do is look back to 1825 to 2020, say, and they've found that value has massively outperformed through that whole period, but it's also had its worst drawdown in the last 200 years, and that's the one that ended in September 2020, which is kind of amazing that it took that long. The drawdown sort of started. It's like a 10 or 15 year drawdown where value hasn't worked very well. So there aren't very many value guys, or not many people who want to identify themselves as value anymore, because it's been so ugly for so long. But I think that it does seem to have turned the corner. Like, depending on what kind of value you are, if you're like the leveraged, shitty kind of companies, you started ripping around September 2020. If you're like me and you're like a slightly higher quality kind of value where they've got reasonable balance sheets and cash flows and things like that, it took a little bit longer because I think there was a bit of short covering, and then the reflation trade, the reopening trade as it was called, for a little while there. And then, so basically mine took about 6 months longer, and my stuff started working around February last year. And that's sort of been the change that people are talking about, like go and buy value stocks. What they're saying is just go and buy stuff that's actually got cash flows and assets. Yeah, right. Because that's traditionally been the way that, that's investing. Everything else is sort of speculation.
Yeah. Well, Tobias, you probably had a tough time there. I think your book Deep Value came out in the early 2010s or mid 2010s.
Top ticked it.
Yeah. So full credit.
2014, absolutely top ticked it.
So full credit for sticking with the value strategy through what was probably 6 quite long years. You must be
a bit longer than that.
You must be reveling in the resurgence of value at the moment.
Yeah, it's been fun. It's hard to trust it yet, and I got to say, since the start of the year, it's been a little bit softer again, because it's weird the way that the market works. Like, probably there's this Ukraine situation building, or whatever it's been since the start of the year. So that means that the Fed probably won't raise rates, which means that the tech stocks all start running again, like as if all of the great rate traders are going and putting on their bets by getting leverage along all of the sassiest stocks in the market, and for some reason that hurts the stuff that I have. So I've had another little sell-off since the start of the year. But when I look at I can have a sort of top-down look at my portfolio and what I estimate the forward returns will be. And as you can imagine, as the stocks go down, the forward returns, particularly in value stocks, get better. And I think they're like 3 times what the ARC complex are likely to do on an annual basis for a long way out here, because the ARC stuff is still expensive. It's hard to believe because it's come off so much, but for a long time they were saying if it gets back to a 10 times sales multiple, that's cheap. But if you look back historically, like, it's very rare that stuff gets as expensive as 10 times. And now, like, 10 times sales multiple for an ARC stock, that's a deep value stock. And I think that's what Kathy's been saying. She's been talking about it.
Yeah, well, I mean, you look at some of those names, like Zoom is still up 30% from pre-pandemic. It just went on a round trip and it was up 500% at one stage. And, Peloton probably flat from where it listed, but it was just, down. Well, it's down 80% from its all-time highs. We want to move and talk about, I guess, the value universe and how you look for opportunity there. But I think we do have to just get your thoughts on where to from here for these growth companies. So when you think about the Teladocs, the Rokus, the Zooms, the Pelotons, the Cathie Wood stocks, do you have a view on what their future holds?
Well, her biggest holding is Tesla. Tesla's still very, very expensive by any measure. It really is assuming an enormous amount of underlying growth. I like Elon Musk, and I think he's a great entrepreneur, but it's just the business is what the business is. It's still growing very quickly. So I think it grew 50% last year, which is kind of amazing. Like, it's a pretty big business. But the stock price is just way, way ahead of where anywhere that it can get to reasonably in the next 10 years or so. So that's her biggest holding. So that'll be a tough, that'll be a little bit of a weight in the portfolio, I think. The other things, like, so Zoom is interesting. So my co-host on my little podcast, he had a bet with somebody where he had Curate, which is the home shopping network, I think. Home shopping network, or one of those, something like that over here. Like, that's not a great business, but they're people who watch that stuff are welded on devotees, and they spend a lot of money on it. And it's controlled by John Malone and the Liberty guys, who are very smart capital allocators. And so they've been doing some financial engineering in the back of that, and that's sort of got that stock moving, and it's massively outperforming Zoom. So he had this little bet with somebody where he was long Curate, which is the owner of that, and they were long Zoom. Zoom's been smashed to smithereens, and Curate's done quite well. But now he wants to reverse the bet, which I think is probably not a bad idea, because Zoom isn't what I would regard as deep value, but it is free cash flow positive, and it is growing pretty rapidly. The growth is slowing pretty substantially, but I don't think Zoom's going away. I mean, I use Zoom for a lot of stuff. Something will become the standard, and it's just easy for everybody to get on the same thing and use it. Then it probably, and at the moment it's looking like Zoom. It's a shame for the guys who started Skype. Like, it could have been Skype. They just didn't update the software for 10 years.
Yeah. Well, they sold to Microsoft, so they're okay.
They did well. It's been sold a few times, right? Is it? Now it's owned by Microsoft. I think things used to go to die at Microsoft, but they've done well with a few other things.
So there's no doubt that you've got a fresh glow about you, and the moment for value investors are here. Your universe is a lot bigger than it was perhaps a year or two ago, and we're really interested to hear about how you're going through the process of filtering through the opportunity set. You've spoken about free cash flow and looking through some of the companies that have taken a big hit. So can you talk us through and talk the community through how you go about filtering and finding investment opportunity?
Yeah, I have a little website that shows what I think are some good opportunities, and you can screen a few different ways. This is the update that I made to this website. So previously it's been in the acquirers multiple, which is basically the way that private equity firms and activist investors think about stocks. You look at the operating income flowing in to the business, which is adjusted for interest and taxes. So that's EBIT, operating income. And then you compare that to the enterprise value. So the market cap is what the stock is trading at, multiplied by the number of shares outstanding. And then it's like owning a house. Like the market cap is the equity in your house. So if you have a mortgage on your house, you could have a $1 million house with a $900,000 mortgage and $100,000 in equity. The equity is the market cap, and it doesn't tell you what the house is worth, and it doesn't tell you how much debt you've got in your house, which are important things to know as an investor. And so what my metric does is it looks at the enterprise value, which is the total price of that house, compares it to the income. So if it was a rental and you were generating rent income, you would want to know how much money does this house relative to another house down the street? And ideally, you want to be generating as much income as you possibly can and paying as little as you possibly can. So that's like the price discussion. That's a very good metric and has worked very well for a long period of time. I do other things in there as well. That's sort of the first cut. But one of the other things that you want to look at is how much money does the company generate on what it has invested in it. So companies like Google and Facebook, they don't have a whole lot of assets in them, but they generate lots of returns. And they've got some protection by virtue of the fact that they're networked, and the more people that use them, the more valuable they become, which is why it's been so in Facebook's example, it's been so important for Facebook to, that Instagram acquisition probably saved Facebook. And now they run this problem where TikTok has grown bigger than they are. And where Facebook and Instagram were social, so you wanted to see what your friends were doing on there. TikTok is different. TikTok is viral. It's what is the most interesting thing that every other person on the site is looking at, and it feeds you that. So you want to go viral, and it's a slightly different sort of approach. But I think that Instagram has achieved a lot of that virality anyway, because there's different ways of engaging with Instagram with the reels, and they've tried to capture a lot of that stuff. But the idea is basically how much assets does it take to generate how much operating income, because we can make it more comparable to the enterprise value discussion that we're having before. So I look for those things. Ideally, you want something cheap, and you want something that can throw off plenty of cash based on what's invested in it. And I try to fill a portfolio up with things that are reinvesting at pretty high rates of return on an incremental basis, that have some sort of protection there, and that have a very long history of actually doing that. So it's very unlikely that I hold a lot of tech stuff. I just tend to hold stuff that's been around for a while. But funnily enough, that does mean that I end up holding, I've got some .com 1.0 stuff in there. I own Oracle and I own Cisco because those are still, and Net Appliance, NetApp, NTAP, they're funny businesses because they're sort of internet plumbing now. They're like almost utilities that make plenty of money. Wow. And because they're cheap, they buy back stock all the time. So that's great if you're a shareholder.
Just speaking of Meta, at the time of the Meta change, Ren and I made a bet that I think it would eventually hit $1 trillion market cap. Ren doesn't think it ever will. Whose side of the bet are you on, Tobias?
Well, so I think it's about 567 billion today, around about there. And I think it's about half price. So I think it's worth about $1 trillion here.
Wow. And that's a deep value investor saying that.
Yeah. So here's the wrinkle to it, though. Here's the wrinkle. So I don't own it, and I may end up owning it. I may not end up owning it. I don't know. I haven't made that decision yet. I don't make that decision for another few weeks in relation to Facebook. But Facebook's price relative to its fundamentals is wrong right now. It's either half price or its fundamentals are going to deteriorate to the point that it's only worth where it's trading. And so the market, we assume that the market is more right about these things than wrong. So the thesis that I have to prove to myself in order to buy this thing is that it's not going to deteriorate as much as that. And they've got some headwinds. They've got some real issues. And that is that, even though the data doesn't seem to show this, the data seems to show that there are plenty of people still using the website. Bots. Even the Blue website.
Yes,
they're all bots.
They're all bots. That's
all
our
bots.
theory.
They're not real people.
All bots.
Yeah, they're not real people.
If our Facebook group is anything to go on, I reckon about half of Facebook's users are bots.
It's nuts.
So that's interesting. So I don't know, because I don't know anybody who uses the Blue Book, and I've got accounts on it that I don't think I've logged into them for like 5 years. I have no idea what's in there. Yeah. But I still use Instagram. Like I started using Instagram because mates of mine were having kids and I wanted to see them with their kids. But now nobody posts on Instagram anymore either. And I'm too old for TikTok. I'm not going to go and figure out how to use TikTok. And my kids are too young to use that stuff. So I'm sort of like, it's not, but that's why I think that business analysis is really, really hard. That's why I tend to be much more of a quantitative type investor. I look at the financials and I try and figure out what the financials are doing. But I acknowledge that, Facebook's got an uphill battle, and this the metaverse thing, I don't know if anybody wants to go back into AOL's walled garden, which is what the metaverse sounds like to me. I don't know, but Zuck is very smart. They earn a lot of money on the money that they've got invested in there. In terms of advertising, there's really only people advertise on Google and they advertise on Facebook, and they advertise more on Facebook because they can get that more granular. They know, what you like and who you are when you're on there. So they like advertising to you that way. I think it's worth taking the bet, but I don't know that it's going to work out, if that makes sense.
That's betting.
That is betting, yeah. So, Tobias, we mentioned a number of quantitative factors there. The market cap and then the enterprise value. We've looked at, return on invested capital or return on equity, things like free cash flow. A lot of quantitative factors. I guess, do qualitative factors like quality of management come into play in your filtering process?
Yeah, so that's an interesting question. So they do, but I've figured out a way to turn them into quantitative factors. And the reason that I do that is that nobody becomes a CEO unless they're pretty charismatic people. They're people who are good at sales. They tend to be pretty good looking, well dressed, fragrant, all those kind of things. Good at telling you a good story.
Anyone can be fragrant.
And yet some people aren't, so explain that.
True.
I'd love to see a study on CEOs and how fragrant they are, and maybe we rank them.
But all of those, the point is that all of those things, you can find that they're very persuasive, and you've got all of these things, that unconscious things working on you when you're talking to them. And so you like to believe what they say. And, does likability or them saying the right thing therefore translate into them executing in that way or achieving those things? Or can they even do that? Because there are always competitive pressures there's stuff going on in the firms. There's just a million pieces moving. So what I like to do is I've turned it into, I've found these sort of quantitative ways of doing it. And one of my favorites is just share buybacks. So that's a very powerful signal. I think there are funds that exist, and all they do is buy stuff that has the highest share buyback going on. And sometimes they short stuff that's got the most shares issued. And so if you think about the reason why that is, a company, anybody can do a buyback at any stage. The buybacks are almost always done at the wrong price at the top of the market. And there's no buybacks done at the bottom of the market. So you'd say that sounds like a terrible factor. But the way that you control it is you say they have to be material buybacks. They have to be material relative to the size of the business, relative to the size of the company. And what that achieves is it tells you that they're generating the free cash flow. They have the resources there to do the buyback. They're able to do it in a material size, which means that it's undervalued relative to what they can spend on it. And it also tells you that management is doing the right thing, that if they are undervalued, often your stock is the best option for you. A lot of the tension, though, is, of course, when you get undervalued in your industry, often there's a lot of other undervalued companies around in your industry. That's a good time to be going and doing acquisitions if you've got the firepower on the balance sheet to do it. So the record of CEOs doing acquisitions is pretty bad. So my preference would be like the least objectionable use of capital is typically to buy back stock. So that's one really simple way of measuring how good management is. Are they doing a buyback? And when you look right now at the big companies that are flowing cash and doing buybacks, they are, like, Facebook's doing a buyback. And that's a good time, I think, for Facebook to be doing a buyback. So that's what the market is telling you. When you get too cheap, the market is telling companies to liquidate. And so responsive management should listen to that signal from the market and liquidate, which is what you're doing when you're buying back stock.
So before we get to some specific companies that are on your screens, and we always find the companies super interesting that you bring to the community, outside of tech and growth sell-off, are there any industries or sectors that are really sort of appearing frequently on your value screens at the moment?
Well, energy has been one for a while. If you needed I sort of joked about this a little bit on the podcast, but the best signal for energy, it turns out the best contrarian signal is when oil went negative, whenever that was, sort of 2020 or whenever that was, late 2020. That was a pretty good signal to go and buy a whole lot of oil companies, because since then they've all had this great rip. And even before oil went negative, if you looked at the composition, at one stage, Exxon was the biggest company in the stock market in the US, and it was for a long time. It occupied a very big chunk of the market. And that whole energy industry has now shrunk down to virtually nothing. And so I think, energy still basically powers the entire economy. And if we have a crash here, it's not going to be because the Fed has raised interest rates. It's because energy has got so expensive, and it sort of achieves the same thing. Energy filters into everything, and it acts somewhat like an interest rate does. It just makes stuff more expensive to do. So I think energy as a sector has been interesting, and the screens were certainly full of that stuff, and they still seem to be in there. And everything from the ConocoPhillips kind of producers to the midstream, to the pipelines, to the ones who do the cracking of the
fracking or whatever it is.
The cracking, it's just escaping me the name of it at the moment, but it's all, the whole complex is cheap, and the whole complex has been cheap for a little while. So typically these things take a long time to play out, and if the Ukraine and Russia thing blows up even more than it is, that's their big energy exporter, so that's going to get even wilder, I think.
So Tobias, would love to move to a couple of individual stocks, because we imagine that it's the stocks that are at the top of your screen are stocks that we probably haven't spoken a lot about on the podcast. Us being young people that are just obsessed with growth names and and vibe companies. So would love to maybe unpack a couple and just hear what the company does. What metrics make it look attractive from a value perspective? And then I guess, are there any risks when it comes to looking at these companies? Could they be a value trap? What's the watch out? How do you sort of navigate that? So would love to turn it over to you. What are some of the companies that are appearing top of your screens at the moment?
Yeah, so that's the one that was in the screen for a while that has started to run a little bit was Lockheed Martin. Was kind of interesting. I think Lockheed Martin's got a little bit more expensive now, but Lockheed Martin was the reason that Lockheed Martin gets cheap is because every time a new president comes in over here, the market seems to get nervous about the amount of money that will be spent on defense, and Lockheed Martin makes a lot of the fighter jets and that sort of stuff. And so Lockheed Martin tends to sell off, but Lockheed Martin's been very consistent for a very long period of time. And so I bought Lockheed Martin last year when it was reasonably undervalued, and it was probably a reasonably good stock too. And Lockheed Martin's done, like when you get some sort of issue in the Ukraine, Lockheed Martin takes off like a scalded cat, which is a little bit, I don't want to be a war profiteer, but as my co-host points out, they only do well when peace comes back. So maybe we're a peace profiteer in that instance. So the things that are in the screen at the moment that really stand out to me, there are two. One is, and these are sin type stocks, but Philip Morris and Altria. They've both got incredible returns on assets over the last 5 years. They're like 40% return on assets, which is extraordinarily high.
It's amazing.
And they're not that expensive.
It's amazing how these tobacco stocks just keep doing it. Yeah. They
seem to have fewer users, but they're quite sticky, the users.
Yeah.
But again, I don't know how good everybody feels about buying those things. They're certainly not, they're not really companies that I feel particularly comfortably holding, and I don't stick them in the fund or anything like that. But they're in there and they're cheap. Facebook is another one, and I think there's a pretty good argument that lots of people think that Facebook is a sin type stock too. So those are the ones that when I open up my screen, they really stand out as being unusually good and unusually cheap. I've also held, so this one of the things that's happened here is that lumber has had this great run. So anything that's sort of close to lumber looks pretty cheap. So there's this Western Forest Group is cheap. And then there's this company, ZIM is the ticker. They're like a shipping company. They're very well managed. They make lots of money. Shippers have been crushing it for the last few years. And that there continue to be issues with shipping. And they said the last estimate that I heard for when it was going to be sorted out coming through the Los Angeles ports was something like late 2023, which I interpreted as like, that's as far out as we can think. And if it goes beyond that, then...
Yeah, we listen to I'm going to get the pronunciation wrong. Maersk, the international shippers earnings call, and they said the same thing. Like mid 2023 was when they're expected to start unraveling.
Jeez.
Yeah.
That just sounds like that's the thing you say when you don't know. You just gee, we hope it's done by then. We can't figure out how it's going to be done, but before then.
Yeah, true.
That's unbelievable.
Yeah, it's funny that you mentioned we've spoken a little bit about Meta or Facebook in this conversation, and it's relevant because it's top of your screens. I seem to remember the first time we spoke, you mentioned maybe not at that time, but previously Apple had been really high up in your screens, and I always just think back to that and think, damn, God, I wish I'd bought Apple.
Well, Apple's funny, isn't it? Because I even wrote about Apple in the Acquirers Multiple because it's one of those stocks that for whatever reason, it's never really had, nobody seems to believe in it consistently because I think it's this, the iPhone replacement cycle is about 3 years and people seem to forget every 3 years, or there's this question about whether people will continue to buy the new iPhone. And so it got cheap in 2013 and I tweeted about it in 2013 and then it got cheap again in 2016 and then it got cheap again in 2019 and that's when Buffett loaded the boat in 2019. And here we are in 2022. It's looking pretty expensive to me at the moment, but it's not in any of my screens, but it wouldn't surprise me if it maybe Buffett buying it has sort of put the Buffett seal of approval on it.
Yeah.
And now it's not going to trade cheaply anymore. But it's been an interesting one. I agree with you. I didn't buy it. I should have.
Yeah. Or people see that Buffett buys it and they're like, oh, it can't be a tech stock if Buffett's buying it. And so maybe that's like a jinx on it.
Yeah. Buffett's the best tech investor, it turns out. of the last 30 years or so. I don't think anybody will like that, but I've been saying that's the greatest trade ever because he put 40 billion or something to work, which is a lot of money, and it was about a third of his book, so it was a lot of money relative to what he was slinging around to, or a third of his cash, and now he's had a lazy triple on it or more. Maybe it's a quadruple now. So in about 2 years, so the old fella's still got it, and he's good at tech too.
Yeah, I mean, it's a pretty good trade, but is it better than when Bill Ackman put that $20 million hedge on and then cried on TV and it turned it into $2 billion?
The biggest no tears, the best no tears bet ever.
Yeah.
The only thing is, so I think you got to give more weight to the bigger trades, because whenever I say that, somebody always comes and points out that the South African company that put the 10-cent trade on and never sold it, Naspers had this big chunk of 10-cent, and so Naspers, I think they put $20 million into it or something like that, which relative to what they had was a pretty big bet, but it wasn't the biggest bet. But then they just held it while it's run up 1,000 times or something like that. Now Naspers has had to split into two, and it's still like the two biggest companies on the South African Stock Exchange. So that everybody says that's the greatest trade ever, but Buffett did it. Nobody knew it. So if you say, okay, well, let's work backwards. If we look at every single stock on the entire stock market and find out who made any trade ever and didn't sell, then you're going to find, this South African company bought this Chinese stock. But Buffett was well known in the most popular name on the market, or one of the biggest companies on the market in Apple, and put an enormous amount of money to work, and it's worked out really well. I think you're not going to get all of those four things together again, or for a very long period of time. So I think Buffett's got it.
Yeah. Crazy.
Unbelievable.
So Tobias, before we wrap up, we are seeing a lot of commentary around buying value, get into value. The time of growth is sort of over, and for our community, it can be a bit of a confusing time to try and navigate. Do you have a piece of advice? If someone is hearing that sort of news, is it as easy as buying a value ETF, or what would you sort of close this up and summarize for our beginner audience?
Well, I have, this is my bread and butter. This is what I do. So there's lots of different ways that you can engage with it with me. So I have a book, Acquirer's Multiple, which is like $10. It's $10 US. I don't know what it is in Australia, but it's cheap, and you can read it in a couple of hours. It's written to a 5th grade reading level, so it's pretty easy to get a grasp of.
So Bryce might be able to get through it.
Yeah, I'm just.
It's really hard to write it to a 5th grade reading level, I got to say. It's not easy to do that, but then that gives you an introduction to the website and how to use the website, and the website has some US names on it anyway. And then I have ETFs that buy names out of those two screens for the most part. And so those are ways that you can engage with my style of value, but there are lots of different styles of value. There are people who are more towards the Buffett end, and people who are even growthier than that. And they're still value investors. They're just doing a different sort of calculation of value to the one that I am doing. But basically the idea is that you've got some fundamental justification for what you're doing when you're buying these stocks. And that's really all there is to it. You think that the business can grow very rapidly for a long period of time, and you can buy it at a price now that gives you a good enough risk-adjusted return over that next 5 or 10 years, or whatever your sort of holding period is. That's value investing. I just think it's a little bit harder than the stuff that I do, but it's definitely sort of a what's his name? Common stocks and uncommon profits. Phil Fisher style of value investing, which is Buffett says that he's 85% Graham, 15% Phil Fisher. And so there are people around who are, 100% Phil Fisher, and they've had a pretty good run over the last 10 years.
Yeah, nice. So a reminder for you guys listening, the ETFs that Tobias runs, Deep and Zig. So check them out if you're interested. Value After Hours is the podcast that Tobias runs, and Deep Value and Acquirer's Multiple are the two books. So plenty of content to keep track of and engage with. And Tobias is, if you want to ask some questions or whatever, I'm sure he would be happy to answer. We won't give out his direct email. But
he's very active on Twitter, although the Twitter handle isn't Tobias Carlisle.
No.
It's
No, it's greenbacked. It's really. I did it because it was the name of the old blog that I had, but it's GREENBACKD. It was like punked. You remember that?
Yeah.
Like punked.
So make sure
green makes no sense. But anyway, it's what I'm stuck with because I've got the blue check mark. I can't change it now.
It's all about the blue check mark. Well, Tobias, as always, it's been an absolute pleasure chatting to you. We love checking in with you, what feels like on an annual basis now, to get your view on markets. And now it feels like it's absolutely your time to shine. So we'll keep track of you over the next sort of 12 months or so, and all the best. And I know that our audience would have taken a lot of value from that conversation. So thank you very much.
That's very kind, gents. Thanks very much for having me. I really appreciate it. I love chatting to you too, particularly. And I see that you guys have been crushing it too. I get a copy of the AFR and a few other little things, so congrats. Well done.
Nice.
Thank you very much. Glad we've made it over to the States in some way.
It was the AFR, mate. It was the AFR.
Oh, yeah, true.
The AFR has made it over to
made it
the
to the
States, and
States.
we've ridden their coattails.
I think I read it on LinkedIn. So.
Oh, damn.
Okay.
Well, thank you very much, Tobias.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.